Hey, this is Mark from Caliber Home Loans. Today is August the 7th, and we're going to talk about rates, what went on this week, what we think is going to happen next week, and look over the last month and actually go all the way back to March just to get an idea of where we've been. And then we'll talk a little bit about the Federal Reserve. So it sounds like, based on last week's meeting, that they may change the way that they set their benchmark inflation rate, which could have direct impact on mortgage rates. So let's go ahead and dive right in. So this is today's chart. So this goes from when it opened, just after the open at 9 a.m. Until the close. And so you'll see that the general downward trend in pricing, which means it puts upward pressure on rates. So most lenders get their rate sheets, most loan officers get their rate sheet somewhere around 10 to 10:30, depending on how volatile the morning is. So their lenders are actually looking at rates, looking at the market prior to 10 o'clock. But as you can see, we were doing okay, lost a little ground here, gained it back, and then we're going to close right around here. So it did put upward pressure on rates from where they opened. We just saw a reprice at Caliber like 10 minutes ago, so not unexpected based on how much it moved. So that's what went on today. So that's today's chart. So let's go ahead and look at the week's chart. So this week we did close, price did close higher than where we started. A little bumpy, as you can see, it went up, then the price went down, which pushes rates up, then the price went up, which pushes rates down a little bit, and then we closed a little bit down. So for the week, we're still a little bit better off as far as pricing. So that's good news for those that haven't locked in yet or locked this week. But again, the range, it's a very narrow range. So, it opened this morning, or at the beginning of the week, just over 105 point, maybe 1.2, and it closed, we're going to close 105.28. So, not that big of a difference really in the grand scheme of things. And again, this is because the Fed is still pouring all kinds of money into the market. So the news that came out this week was the ADP employment and the employment numbers. So they were actually a little better than expected, but which typically, remember, good news on Main Street is bad news for interest rates because it's considered inflationary, and bondholders, the only way for bondholders to fight inflation is to raise the yield on the bonds. So, but again, because the Fed is pouring millions of dollars a day into the bond market, it just isn't having that much of an effect. So let's look at the past month. So you see that we did start here about 104.4, and we're closing at 105.27. So it's a nice rise over the last month. So rates did get better over the last month, and again, the rise looks better than it is. It's still a fairly narrow range. So let's go ahead and look at as far back as I can get. So this is really in March. So this is in March, and this is when the Fed really started pouring money in. And so really, again, the line is for that long of a period of time since March, the line's pretty straight. I know there's a lot of volatility going on from day to day and week to week, but the line's pretty straight. And again, this comes because the Fed is dumping all kinds of money into the market. So next week, so let's take a look at next week. So the Consumer Price Index comes out on the 12th. That'll be interesting. We don't really expect to see too much of a movement. Weekly jobless claims will be on Thursday. Again, it just depends on whether more people lose their jobs than expected to. And really, those are the primary movers, the biggest movers for next week. But let's talk about what the Fed is talking about doing. So for the last couple of years, the Fed has used 2% inflation as kind of a benchmark. They wanted to keep the rate of inflation at 2% or less. And when inflation starts to go up over that number, they tend to react on their end. So they'll lower rates on their end to push rates back down. So they're thinking about changing that. And if they raise the bar, so if they go to 3 or 4%, and they allow inflation to rise 3 to 4%, that's going to have a direct impact on all bond markets, both the government bonds and the mortgage bonds. So again, when investors, especially institutional investors, they buy bonds and they hold them, and they buy them for the yield. And if we know that if we think there's going to be future inflation, then the bondholders will want a higher yield to hedge against that future inflation, which drives rates up. And I'll do it both on the mortgage side and on the government side. So we'll have to see what their final ruling is and how long it's going to actually take them to do this, because again, I don't think they're going to do anything with the current status that we're in economically until at least 2021. So that's kind of my guess based on everything that I've been reading and listening to. But it'll be interesting to see what happens, because if they do raise the bar, if they do change the guidance, then it will have a direct impact on mortgage rates, and rates will because at some point the Fed's going to stop buying bonds. They can't do this forever. And so when they do that, that alone will cause rates to go up. And then if the inflation rate starts to creep up over 2-3%, then you're going to see bondholders demanding and trading for a higher yield, which will push our rates up also. So again, I've said it before and I'll say it again, we don't know what tomorrow is going to bring. We don't know what rates are going to be. If I knew that, I wouldn't be doing this for a living. But it's just one more reason to talk to prospective buyers. And if you're thinking about buying or refinancing, I would pull the trigger. I mean, you just don't know what's going to happen. So having said that, if you need anything this weekend, give me a shout, 248-705-8431, and have a great weekend.